All right, boys and girls, we are back. Um, Lesson 4. This is going to be a real doozy. I know we've already gone over a ton of stuff. It's been really, really exciting. We've learned a lot of great things, but now we really, really start to get to some of the fun stuff. Some of the fun stuff that options can tell you and do for you that no stock, no indicator, no nothing can do. The cold hard facts that we just discussed in the previous episode about the options Greeks, we're going to expand on those even more. So while the previous lesson about options Greeks were very insightful, um, we're really going to be able to expand on that now. So the title of this lesson is "How far will the S&P go in the next 30 days?" So it's very interesting, and I'm going to give a little bit of a little bit of a speech here. So bear with me, but it's very interesting. At the beginning of every single year in the market, you have all the big sell side analyst banks. You have Goldman Sachs, J.P. Morgan, Bank of America, Jefferies. You have all these big banks, as well as all the pundits on television like CNBC and Jim Cramer and Bloomberg, and all these so-called experts and all these money managers. What do they do at the beginning of every single year? What they do at the beginning of every single year is they give their expectations, their predicted price of what the S&P is going to do over the course of the next year. Some say it's going to go up 20%. Some say it's going to go up 5%. They almost never, ever, ever say it's going to go down, but they all give their expectations. And what happened is, starting in about November, these analysts, they fly all over the world. They meet with all these CEOs, they meet with all the big banks, and they calculate all this data. And these firms spend millions and millions and millions and millions of dollars coming up with these predictions, because the off chance that they're the closest prediction to the actual closing price of the S&P for the year, well, they're going to get a ton of money, a ton of revenue, and a ton more big clients, institutional and retail clients. So it's a really big deal for these guys. And like I said, they spend a ton of money, a ton of man hours, private jets all over the world to try to figure out what the S&P is going to do in the next year. I laugh at that. I'm not laughing right now because this is like a very serious matter. I'm very passionate about Options Hero and teaching you guys this, but that is a complete laughing matter, because the market can tell us the answer to that question in no more than 60 seconds. So when I think about how far would the S&P go in the next 30 days or in the next year, I know off the top of my head, and you will know in just a few minutes, exactly what the market predicts. Not what these banks predict, not what these guys in suits and $1 million bonuses think, not what these guys sitting in a New York bank think. It's what the market thinks. And the reason I say what the market thinks, and the reasons why it's so important, is because that there are trillions and trillions of dollars over the course of the year that bet and are and have products that are priced off of this expectation. So if this expectation that the market has isn't accurate, you would have a different number, and you wouldn't have trillions, I'm serious, trillions and trillions and trillions of dollars betting on that number to happen. So there is something that I'm going to be able to, again, show you just in a few minutes, that's going to be able to tell you in less than 60 seconds exactly how far the market can go in the next 30 days, 60 days, 90 days, 100 days, and ultimately 365 days, or 5 years. Whatever you want to look at, this can tell you. And it's dead ass accurate, because there are trillions of dollars worth of bets that are priced off that number. It's a two-sided market. People can buy or sell based off that number. If the number is wrong or inaccurate, or people think otherwise, they have the opportunity to move that number. So it's an efficient number, it's an efficient market, and it really comes out to be true. So, this is Dr. Evil here, saying, hey, how far would the S&P go in the next 30 days? And I promise you, we're going to show you, and we're really going to open your mind up to some of the potential that options have in this Options Hero course. So let's just get it out there. Let's just like I'm being real right now. Let's just get it out there. What does the market know, right? This isn't like insider trading information. This isn't like, oh, hey, the Fed number moves a minute before the number actually comes out. Like, what does the market actually know? And the truth is, the market doesn't know shit. Let me repeat that. The market does not know shit. The market has no idea where stock is going. In fact, there's a really good argument that most price movement is accurate. We're not going to get into that in Options Hero. On some of my other courses and some of my other web training classes, we get into that. But the truth is, it's all pretty random. The market doesn't know shit, right? So the market doesn't know up or down, but what the market does do is it places bets, and I alluded to this earlier, but it places bets on how far they think a stock could go up or down in a certain period of time, right? So that's where it becomes very, very interesting. Again, the market collectively doesn't know jack, okay? People are betting on things all day. There are certain products, and you're going to find out again in just a few minutes, that are priced off of this bet of an expected move or an expectation of how far up or down a stock may move in a certain period of time. So again, they can't really predict up or down. They can't really predict like bull or bear or anything. All they can do, all they can do is place bets on how far a stock may go in a given time. That's it. This is really, really important for you guys to understand. This is really, really important. The market doesn't know anything. The truth is, if you got a stock's earnings, if you got the number of what the earnings were beforehand, and they were really, really good, let's say compared to expectation, there would not be a greater chance that the stock would go up than otherwise, right? Because there's so many participants, they're looking at so many different things. Again, the market collectively does not know jack. They don't know up or down. What they do know is the predicted price movement up or down for a certain period of time. That is it. And the majority of products, like options, are priced off of that, right? And again, it's a dead accurate number because there's trillions and trillions and trillions of dollars worth of products that are priced off of that. And again, if someone thinks they're wrong, it's a two-sided market, and they can move the market as far as they want if they think that number is inaccurate. And again, we're going to get to that in a minute here. So thinking back to where we were not too long ago in our options Greek lesson, right? Who remembers delta? So delta, just to go back, delta was two things. Number one, it was your synthetic stock position, and it was your directional risk. So if we bought, again, a 30 delta call, we would, number one, have the synthetic equivalent of 30 shares of stock. And number two, since delta represents a $1 move in stock, if we owned a 30 delta call and the call was currently trading for $1 and the underlying stock were to go up $1, that call would theoretically be worth around $1.30 now, right? So that's what delta is. But actually, there's a secret about delta that I haven't spoken about yet that I'm going to allude to here. And this is, I'm telling you guys, I've been doing this for 10 years. I've been teaching people for that long. I always get so excited to do this. I'm getting goosebumps just thinking about how I'm going to say this to you guys because it's so, so, so exciting. It's going to change you forever. As long as you're in the market, the next bullet point that I'm going to say to you is going to absolutely change you. It's going to give you so much confidence. It's going to blow your mind. Just make sure you're sitting down. Make sure you're relaxed. But just hear me out on this one. Not only does delta do the two things that I mentioned before, but delta also tells us the chances that an option is going to expire in the money. Now remember, we're building on everything here. We talked about in the money. In the money for a call is the price of the stock is greater than the strike price of the call, and in the money put is the inverse, right? Is the inverse. So an in the money put is the price of the stock being below the price of the put, right? So the delta tells us the chances of that happening for either a call or a put. So it tells us the chances of an option expiring in the money, right? Now, what does that actually mean though, right? If an option is in the money, that kind of tells us like, what are the chances that happens? So Not if it's saying, if delta is saying, what are the chances an option expires in the money? It's pretty much saying, what are the chances an option makes money, right? If we buy a call or put, we pretty much are only making money if an option is in the money when it expires. If it's out of the money, it has no intrinsic value. It only has extrinsic value, and thus it's worth absolutely zero. So calls and puts that are purchased are only valuable at expiration if they expire in the money, right? So if delta tells us the chances of an option expiring in the money, delta pretty much says, what are the chances we're going to make money on this option trade? That is so powerful. Don't worry, we're going to build on that. But again, delta is your new best friend for the rest of your trading career, whether it's the next 10 years or the next 50 years. Delta is your new best friend. It gives you reasonable expectations about what the collective market believes the chances of an option expiring in the money / making money are. It's a big deal. Now, this builds on a lot of what we talked on before. We had a lesson on liquidity, and liquidity is so important. The more liquid an option is, the more accurate that number is. So if we're going to stay away, from all of these stocks that don't fit our 7-point checklist for liquidity, these numbers are even more accurate. So the chances of an option making money is more accurate the more liquid a product is. That's why it's so critical to only be involved in the most liquid products. So who has seen what we're looking at right now? For those who haven't, and as a reminder for those who have, this is, well, not only the last slide in this video, it's also a normal distribution curve, right? This is a pure mathematic, non-emotional model. And what a normal distribution curve says, given a large enough random sample size, 68% of occurrences will fall between one standard deviation. So, in other words, that means 68% of the time, the outcome will fall within the average. 95% of the time, the data will fall in between two standard deviations or 2 times the average. And 99.7% of the time, the data will fall between 3 standard deviations or 3 times the average. Right? So if we take a data study of like 10,000 different random occurrences, right? 68% of those are going to fall within the average or within 1 standard deviation, right? So this is a pure math thing, right? And what's really cool about this is going to start putting us in the direction of, hey, the market is trying to predict, how far a stock might be able to move up or down in a given period of time. And it all kind of comes down to this, which is like the really cool thing. And what's really extra cool about it for me is that it's just numbers. It's not emotion. It's not, I think this stock is going here, or, I read this research study on this stock and then this analyst said to buy it. It's not that. This is how options are priced. They're priced off of what you're looking at right here. This ugly chart with ugly colors next to what I think is a really cool Options Hero logo, right? So again, 68% of the time, occurrences will fall within 1 standard deviation. 1 standard deviation is the average. In terms of options, what that means is this. Make sure you write this down. 68% of the occurrences fall within 1 standard deviation. In the world of trading, in the world of investing, and specifically in the world of options, 1 standard deviation is equivalent to the expected move. So I'm going to click a bunch of buttons here. How far will the S&P go in the next 30 days? Think about that for a second. How far will the S&P go in the next 30 days? And remember, the market doesn't know shit. All they know is how far they think a stock might be able to go up or down in a certain amount of time. The way I see that is the market can predict the expected move. So let me say that again. 68% of the time, 68% of the time, on random occurrences, these data points and these price movements will fall within one standard deviation. One standard deviation is the expected move. Remember, the market doesn't know jack. They don't know anything. However, they place bets that are trillions and trillions and trillions of dollars on that expected move, right? On that expected move. So, cool. We're getting really, really close to be able to do this now. So, let's find out how we figure out what the hell is going on with the expected move, right? Now, what's going to help us do that? That's right, your new best friend Delta, because Delta tells us the chances of an option expiring in the money, right? So let's go to the trading platform real quick here, and let's go to SPY. And it doesn't matter which expiration cycle. We always like to go to these white ones again, these monthly expiration cycles. And what I'm going to do is I'm going to get rid of all this other stuff because none of it matters as much as Delta matters. Come on, get out of here. Go. No, we want that. We want you out. Great. So none of it matters as much as Delta. Remember, Delta is the chances an option expires in the money, aka the chances an option makes money at expiration, right? So Delta, again, in here, we're looking at the September 17 SPY, S&P 500 Index ETF options that expire in 44 days. The deltas are the equivalent of those options making money at expiration. So let's look at a few examples before we try to figure out what the hell's going on with this expected move type thing, right? So let's go ahead and look at this. I want to look at the 252 call. The 252 call right now, the bid is the most someone is willing to pay currently, and the ask is the least someone is willing to sell for, right? So we see a bid and the ask of 60 and 62 cents. And again, most importantly, your new best friend, literally forever, I'm telling you, is a delta of 20. So if we go back here, delta tells us the chance of an option expiring in the money at expiration. So if that is just the basic definition, what are the chances this 252 call is going to finish in the money? Or make money in 44 days at expiration. So think about that. I'm going to give you the answer, but think about that. Right? Now remember, delta are the chances an option expires in the money at expiration. If an option that you have bought expires out of the money, it's worthless, so you don't make any money. So it has to expire in the money. The chances that the 252 call, the way we see it on the screen right now, that the 252 call expire in the money are equivalent to its delta. It has a 20 delta, which means, drum roll. Can you hear my drum roll? There you go, drum roll. Again, I'm so excited about this. This is gonna blow your guys' minds. The 252 call has a 20% chance of making money. Pure math. Again, how many options contracts were traded today? 2 million options contracts. If that wasn't the case, if it was not the case that the 252 call, if it wasn't the case that it had a 20% chance of expiring in the money, thus making money, this option would not be priced that way. Would not be priced that way. But again, one, we're looking at liquidity. SPY is the most liquid product in the world, so we know that these statistics are the most accurate. We can trust these the most. This is saying, no matter, this is where everything is, where prices are today, with geopolitical risks today, with everything going on today, the way the price moved today, all this jazz with earnings, blah, 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 all those factors in, the 252 call has a 20% chance of being profitable at expiration. Now, here's the thing. Here's the thing. that is also saying that SPY only has a 20% chance of finishing over 252 44 days from now. Now we're getting a little bit closer. Now we're getting a little bit closer, right, guys and gals? Now we're getting a little bit closer. Let's do another one here real quick. Let's do the 249 call expiring in 44 days. Now, that 249 call, let's try to figure out what percentage away that is. So 1%, 0.2, 0.0, 0.8, 0.75, 0.73. Oh my God, come on. There you go. All right, 0.70. Great. Okay, perfect. This will be really, really good. Now, remember, from the top, the market doesn't know shit. The market can only predict potential price movements up or down and the magnitude of those moves. That is known as the expected move. That is known as the expected move. Remember, we want to know how far we think a stock can go up or down in the next 30 days. The market predicts the expected move, and all options are priced off of that expected move. Now, again, trillions of dollars are bet on this every single day, so if these numbers weren't right, they wouldn't be the way they are right now, right? Now, delta tells us the chances a stock finishes in the money. And if we go back to our slides, that is the same thing as the chances of making money. We talked about a normal distribution curve of random occurrences says that 68% of the time price movements, since we're relating to options and actual price movements, 68% of the time price movements will land within one standard deviation or the expected move, right? So we're adding on this, we're getting a little closer. Let's do the 249 call. The 249 call has a 39 delta. That means that SPY has a 39% chance. 39% chance of finishing over 249 in the next 44 days. That is how options are priced. That is how everything is priced. So you might be saying, Steven, wait, the market just goes up all the time. The market just goes up all the time. What are you talking about? We're in such a bull market, tax reform and the Fed's keeping rates low, all this stuff. Steven, doesn't matter. That does not matter. This is pure statistics. This is pure numbers. This is what the market expects. The market expects that there is a 39% chance that S&P only goes up 0.7% in the next 44 days. That means when these options expire in 44 days, SPY and the market only thinks that there is a 39% chance. A 39% chance that the 249 call is profitable at expiration. That is some serious stuff. That is not guessing. That is not sending people off to China or Japan to come up with their predictions. The market prices this in for you. That is really cool. So let's look at the put side, right? So the put side is slightly different. Let's look at the 241 put. Now, the 241 put has a negative 25 delta, right? So we always want to take the absolute value when we are looking for expected move and also the chances that an option makes money by expiration or at expiration. We always want to think that we're buying an option and we're taking the absolute value or the positive value of the delta. So the way I see this is as a negative 25 delta. However, we're going to call it 25 for our discussion purposes. So 241. Right now, SPY is at 247.44. We bought a 241 put. The 241 put has a 25% chance of finishing in the money, which means SPY only has a 25% chance. Only has a 25% chance of finishing below 241 44 days from now. That's all that means. That's some serious, heavy duty, big time stuff. You knowing what you know right now have no idea how much you know. You have no idea how much further and more advanced you are than money managers, than hedge fund managers, and than people that have been doing this for their entire lives. They don't even know this stuff, and you already know it. So I'm going to clap for you guys right now. Congratulations. That is phenomenal that you know that. you're going to be able to use this for the rest of your life. None of this is going to change. None of this is going anywhere. It's always going to be around. Amazing. So a lot of you are probably saying, well, Steven, this stupid graph you have over here, what does that have to do with anything? What does that have to do with anything? And okay, that's fair. That's fair. So let's go to work with it, right? Let's do some math, guys and girls, excuse me. If 68% of the time the data falls between one standard deviation, and one standard deviation is known as the expected move, we have to figure out how the hell to find where this 68% comes in, right? Remember, in options delta are chances it finishes in the money. This 249 call has a 39% chance of finishing in the money, right? So SPY has a 39% chance. The way everything is today, right now on my screen, has a 39% chance of finishing above 249 44 days from now, while at the same time, it has a 25% chance of finishing below 241 in 44 days from now, right? So let's look at here, right? So this is just pure math. Again, this is no emotion, no, fearing greed, no high frequency trading. This is like, and by the way, high frequency traders don't do anything in options. They can't. So if you're worried about like trading options or worried about stock market because of high frequency traders, they actually can't. They don't have access to options. So that's just just an aside. So we ultimately want to find out where the hell is this sweet spot in the middle, this expected move, this one standard deviation, right? So if it's going to happen 68% of the time, we need to find out the option that is going to take us from here, bear with me, all the way over, and here, all the way over. Right? So again, we want to find the option that's going to say, okay, between this call and this put, we expect the market to fall 68% of the time, right? And the way we're going to do that is actually simpler than you could possibly believe. It's simple math. 100% of the time is the only number we can start with. And remember, we want to find how to get that 68%. So what we're going to do is we're going to subtract 68 from 100 and we get 32. So what this says is 32% of the time, the market will be outside of the expected move. 32% of the time, it will be outside of one standard deviation. Again, I'm not making this up. I'm not like coming up with this stuff on the fly. This is pure math. This is pure math. If 68% of the time the data falls in between this one standard deviation or this expected move, it makes sense 32% of the time, just pure math, pure basic math, that prices will finish outside of that one standard deviation or expected move. Now, what we want to do is we want to find the options that can say, okay, in between these options is 68% of the time is expected to expire. Thus, we can say this is the expected move up or down in the stock. So the way we're going to do that, remember, 32% of the time prices fall outside of it. And what I'm going to do is just divide it by 2. And what do we end up getting? We end up getting 16, right? So let's add those here and just take a look and see if that makes any sense. So I'm going to use the font that I use everywhere. I'm going to do this. I'm going to go 16, right? And then, remember, both sides are going to be 16. 32 divided by 2, 16. I'm going to do that. That is just off. There we go. Great. So now this is making a little bit more sense, right? If 32% of the time an option will expire, or prices will fall outside of the expected move, 68% of the time they will expire within. And then 32% of the time we get 32 divided by 2, and it's 16 deltas on each side, right? So again, I'll move these out here. there's a 16% of the chance, and one of the things you could actually do, and I'll do this real quick. This will probably make it a little bit easier. Let's assume this is the put side. And I'm gonna make this like giant. Like this is the put side, and this is the call side. Even up. There we go. And this is the call side. So what we're saying here, pure math, is 68% of the time, prices will fall within the expected move or one standard deviation, right? 32% of the time, they won't, which means just based off of pure random occurrences in a normal distribution curve, 16% of the time, prices will fall outside of the expected move to the downside 16% of the time, and 16% of the time price movements will fall outside of the one standard deviation to the positive side, right, or to the upside. So down and up, and there we go. Right, so down and up. So again, 16% of the time, because prices will fall within a one standard deviation or the expected move 68% of the time, they will fall outside of the expected move 32% of the time. 16 or half of the time, they will expire, or prices will fall above or outside to the positive side of the expected move, and 16% of the time, they will fall to the negative side or outside of the one standard deviation expected move. So all we need to do is go find the options where that is possible. So again, if here we're saying there is a 25% chance, there's a 25% chance. Let me repeat that, a 25% chance, because the delta, and we do the absolute value of the delta, 25 delta on the 241 strike, there is a 25% chance that SPY finishes below 241 at expiration. Remember, we're looking on the put side and on the call side for the one that gives us a 16% chance. So let's go down to 16. We see that the 16 delta put is 237. This buying the 237 call gives us a 16% chance of making money on that call. Let's go back here real quick, or excuse me, on that put. On the put side, we're looking for the number. We're looking for the number that says 16% of the time prices will finish outside of the expected move or the one standard deviation to the downside. The 16 delta put says there's only a 16% chance that prices will finish below the 237 strike, which means the 16 delta on the put side is the lower barrier on the expected move of the stock. So the expected move on the downside of SPY in the next 44 days is somewhere up to the 237 put. Now on the upside, we have to look for the delta that is closest to 16 as well. The closest delta to 16 is the 253 strike, right? And again, why are we doing that? The reason we're doing that is because 16% of the time we know that these random price occurrences will expire or finish outside of the expected move to the upside, right? To the upside. So we need to find the call that represents that, right? So this call is not a 16 delta. However, it's the closest one. It's 14. So again, looking at this chart, we want to find the option or the strike that says there's a 16% chance of this happening, right? 16% chance of happening is a 253 call. And then on the downside, we want to find the option with the 16 delta. We want to find the option that says there's a 16% chance that things are gonna happen over here, right? And the one that says there's a 16% chance of things happening outside of that expected move is that 237 call. So if we would like to know, as you guys have seen right here proven to you, if you would like to know how far a stock might be able to go in any amount of time here is what we do. Let's say we want to know, SPX. And we want to know how far the market, not some analyst, right? Not some analyst. We want to know how far the market believes. The market believes the S&P 500, right? So the SPX is the S&P 500 index, right? Pretty straightforward. And we want to know how far the market thinks the S&P 500 is going to go in the next 30 days, up or down, right? So the expected move, up or down, in the SPX, the S&P 500, what we do is we go to the 16 delta put. Let me hide my positions here. Great. We go to the 16 delta put, and the reason for that is, again, because 68% of the time prices will fall within the expected move. 32% of the time they will not. 16% of the time, or half of that 32% of the time, they will finish above. And the other half of that, 16% of the time, they will finish below. So we want to find the option where those things happen, where there's only a 16% chance of prices finishing above and then below. So right now on the put side, we're finding the option where there's a 16% chance prices will finish below. Again, this is just pure math. And that is a 2400 strike in the next 30 days, with the SPX being at 2477.57 right now, right? On the upside, we also want to look for the option that's the closest to the 16 delta call. The closest one to the 16 delta call is the 2515 call, right? So you want to know how far the market can go up or down in the next 30 days. Here you go. You go to the expiration cycle that's closest to the time that you would like to look for. So I should have said that earlier, my apologies. So if we want to go to 30 days out, we go to the stock we want. In this case, I'm going to the SPX because that is the market, and I'm going to the expiration cycle closest to the time frame that I'm interested in. Remember, we want to know how far the market could go in the next 30 days. We're going to click on that. We're going to find the 16 delta put, because remember, 32% of the time, prices will fall outside of the expected move. Half of that, or 16% of the time, they will finish outside of the expected move to the downside, or 16. And half of the time, they will finish, half of that 32%, or another 16, they will finish outside the expected move to the upside, right? So again, the way to find something has a 16% chance of finishing in the money, if we buy a put, in the money is below. If we buy a call, in the money is above, right? So again, we're looking for that 16 delta. We find the 16 delta, 2400, and then on the call side, we find the closest option to the 16 delta, and we find the 2515 strike. In the next 30 days, the market is predicting this. Trillions and trillions and trillions of dollars are betting on this. So again, if you're like, I don't believe that for a second, I don't believe that for a second, not only do you have the opportunity to come in here and make bets that are completely different than that, but every other market participant has that opportunity too, right? So this is some really, really cool stuff. So how about this? If you're really worried, really worried about your downside, how much money could you possibly lose in the next 30 days? Well, let's take a look at that. Let's say we own 100 shares of SPY. 100 shares of SPY. We own 100 shares of SPY. Let's get rid of this. And let's just say we own 100 shares of SPY at 44, right? 100 shares of SPY. The reason I changed it to 44 is that's the closing price. It looks like the market is down like a little bit after the close, but it's the closing price. So let's say we own 100 shares, right? We own 100 shares, and we want to figure out the most amount of money. Actually, they're giving me agita here. The most amount of money that we can lose in the next 30 days. Remember, the market doesn't know shit. You and I don't know shit. However, the market places big bets on the expected move, right? On the expected move. So what we do is we find the 16 delta put, right? If we're long 100 shares, we want to know how much we can lose. And let's do this. 239.5 is the 16 delta put. what is this? What are we doing here? Let's say dollars. So 247.27 minus 239.5, 777 minus 777. Great. So the worst case scenario, well, the worst case scenario is bad, but the expected outcome, the worst expected outcome for your 100 shares of SPY in the next 30 days is only down $7.77 or $777 if you own 100 shares, right? And the truth is there's only a 16% chance that you lose more than that. That's pretty awesome, which means you have an 84% chance of losing less than $777, right? So that's a really, really big deal. Now, I want to know, remember, these analysts make a huge shit. They make a huge to-do. They make a huge deal about how far the market is going to go in the next year, right? How far the market's going to go in a year. Remember, they take their private jets all over the world. They go to Nobu for every dinner. They have all their guys working all weekend and all night talking to all these companies in the S&P 500. Hey, what's it going to look like? What's the dollar doing? What's gold doing? What's the Fed going to do? Like, what's going on with, geopolitical things, right? And they spend all that time doing all that. They spend all that time doing that. But we're going to go figure out exactly how far the market thinks. The market thinks the S&P can go up or down. Let's do it for the rest of the year, nice and easy. So today is July, August something, right? January, and we're going to go to the We're going to go to the 29 Decembers. So the options expiring the last trading day of the year. Those are the quarterlies, right? And again, let's go back to the basics. Let's go back to the beginning. To the beginning. We want to know how far the market will go by the end of the year. Let's change that. By the end of the year, Dr. Evil, right? The market doesn't know anything, but it can predict movements up or down. An options delta tells us the chances of that option finishing in the money in any given time, right? Or the chances that option makes money. For a call, in the money is above, right? So if we buy a call, the options delta will tell us the chances that the stock finishes above our call at expiration. If we buy a put, in the money is below the strike price. If we buy a put, that's delta will tell us the chances that our put expires in the money or the price of the stock expires below the price of our put, right? And what we have here, remember, 68% of the time, prices will fall within one standard deviation. One standard deviation is nothing more than the expected move. If prices will fall within the expected move 68% of the time, they will fall outside of the expected move 32% of the time. Again, very basic math. 100 minus 68 is 32. 16% of the time, prices will fall outside of that expected move to the upside. So if we want to know the expected move to the upside, we want to find the option that tells us there's a 16% chance that it finishes in the money or prices will finish above. That is the 16 delta call. So if we want to figure out how far the market can go, the market can go by the end of the year, that's 149 days from now, we find the 16 delta call. The closest one of that is the 2600 strike. And again, that was the upside. Now again, prices will fall. I'm going to say this at nausea because this is a big deal. Prices will fall within the expected move 68% of the time, which means they will fall outside of the expected move 32% of the time. Half of that 32% of the time, prices are expected to fall outside of that expected move to the downside, right? So 16% of the time. The way we find that is we go find the option or the put that says this put will be profitable 16% of the time, right? So prices falling outside of that expected move, this put will finish in the money 16% of the time. The way we do that is you go find the 16 delta put. Sorry, the phone rang. I had to pause this real quick. I didn't want the phone to ring together. But again, we're looking for the 16 delta put because prices will fall outside of the expected move to the downside 16% of the time. The option, the delta on a put that says options will finish below, or prices will finish in the money on that put 16% time, is the 16 delta put. So the 16 delta put is a 2250 strike. So remember, all of these banks, all these research funds, all these hedge funds, Vanguard, T. Rowe Price, all those geniuses, right, that think they know more than you, they do not. You now officially know far more than they do. The expected move as priced in by the entire market, which again is trillions and trillions and trillions of dollars bet all day, every single day on this, the expected move to the upside in the S&P 500 for the end of the year as everything stands today. It will be different tomorrow. It will be different at the end of the day, but it will always be the 16 delta call and put no matter what. To the upside, the market is betting that there is only a 16% chance that the market will finish above 2,600 149 days from now. And at the same time, they're saying there's only a 16% chance that the market will finish below 2,250 in the next 149 days or by the end of the year. So this means the expected, let me make this bigger here. The expected move in the S&P 500 from today to the end of the year is somewhere between 2250 and 2600. And again, the market says 68% of the time prices will fall within one standard deviation or the expected move. This is how we find them. So again, based off of pure math, off pure market expectations, off of trillions of dollars of betting on this, the market is currently saying, as everything stands today, the market is expected to close the year between 2,600 and 2,250. So if you're worried that the market is going to collapse to like 1,800 or 2,000, the market is saying, as everything stands today, it's not a great chance. In fact, if you're worried about the market going down, let's say 20% to 2,000, the chances that the market sees that happening are only 5% by the end of the year. 5% by the end of the year. So what is the fear if 95% of the time the market is expecting that not to happen? Right? What is the fear of that? You can't ever be betting on some black swan to happen. If you're sitting there worried that the market is going to close the end of the year below 2,000, you're wrong. The market today, as everything stands, is only betting there's a 5% chance that happens. Now, geopolitical things can happen. Again, this changes all day, every day. But as we stand here today, August, whatever today is, August 2nd, 2017, this is how the market sees it. So some of your stocks, let's look at some favorite stocks out there that people really, really like. Very simple. We want to find the closest put and call to 16 delta, right? Because that in between a 16 delta call and in between a 16 delta put is a 68% chance of something happening. And that is the expected move or one standard deviation. So the closest put to 16 deltas in Apple is the 135 strike, and the closest call to the 16 delta call is the 180 strike. So without any analyst bullshit, without any of this other stuff, Tim Cook said this, iPhone 8 this, as everything stands today, the market believes that the expected move, based off the expected move, that Apple will close between 180 and 135. That is how everything is priced right now. Let's look at something else like Amazon, which, by the way, is an absolute freaking beast. But remember, prices will fall within the expected move 68% of the time, which means they will not fall within the expected move 32% of the time. Half of that, or 16% of the time, prices will fall outside of the expected move to the upside. The way we figure out if something is going to finish outside of the expected move to the upside is the option that gives us a 16% chance of finishing in the money, right? So that's the 16 delta call. So in Amazon for the end of the year, what is the 16 delta call? It's the 1170 strike. And again, now we figured out this whole part. On the downside, it says 16% of the time, prices will fall outside of the expected move to the downside. In order to say that, we have to go find the strike or the option that's going to give us a 16% chance of finishing in the money. That's the 16 delta put. So how do we go find that? We go to the options change and we find the 16 delta put Bang. So what we're saying right here, no matter what analysts say, no matter how good Prime Day is, no matter how good all these subscriptions are, or AWS, or all this stuff, as everything stands today, emotionless, pure market liquidity. The market is saying Amazon will close the end of the year. The expectation is they will close the end of the year between 1170 and 865. So again, if you think Amazon is going up to 1300, the market believes there's a 5% chance that's going to happen. If you think Amazon is going to like crash and go to like 600, the market believes there is a 1% chance that happens. And let's look at another one. Let's look at another stock that people absolutely love. Netflix. People love Netflix. Actually, Tesla. Netflix. Right? Again, we want to go to the expiration cycle that's closest to the time frame we're looking for. So we're looking for the end of the year. The December expiration cycle is the closest to that. 68% of the time, I can't say this enough, you're probably really annoyed with me at this point, but the truth is 68% of the time, prices will fall within the expected move, right? Which means 32% of the time they won't. Half of that, or 16% of the time, they will finish above that. In order to find the price that's above that, we want to find the option that gives us a 16% chance of finishing in the money. The option that gives us a 16% chance of finishing in the money, just according to options markets and perfectly priced markets, is the 16 delta call. So we have a 15 delta call and a 16 and a 17 delta call. We're just going to go with the 15 delta one to make it nice and easy. Nah, that looks a little weak. There we go, 16.78. So the market believes that the upside potential for Netflix by the end of the year is 225, which is freaking huge. Now again, we want to find the downside. 16% of the time, prices will finish outside of the expected move to the downside. The way we find that is we find the option that gives us a 16% chance of finishing in the money to the downside. That is the 16 delta put. We go over to the put side, we find 16 deltas, bang, 150, and there we go. The expected move in Netflix by the end of the year, based off of everything that there is today, is between 225 and 150. So if you're one of those people that think Netflix is going to go to, let's call it 250, there's an 8% chance of that happening, according to what the market is saying right now. 8% chance. So guys, that was really cool. We learned a lot. This is obviously my favorite lesson, but I'm going to go through this just one more time real quick. Again, these videos are yours. These slides are yours. Like, it's all yours, all this stuff. Like, this is all great stuff. The market doesn't know shit, and they can't predict anything. All they can do is place bets on the expected move up or down for any given time frame. Delta, we talked about Delta in the past. It did two things. Number one, it gave us our synthetic stock equivalent. And number two, it told us how much the option is going to move in value based off of a $1 move in the stock. Now we also know that Delta tells us the chances that an option finishes in the money, right? In a normal distribution curve setting, prices will fall within one standard deviation or the expected move 68% of the time, which means 32% of the time, prices will fall outside of that expected move. Again, 100 minus 68 is 32. 16% of the time in a normal distribution curve setting, prices will finish outside of the expected move to the upside. If we want to know the strike price that gives us a 16% chance of finishing in the money, we need to find the 16 delta call. So let's go to another stock then real quick. Google, and that'll be the last one. I've actually done really, really well with Google this year. Wow, Google's a 947. Good for them. Again, we want to find the option that gives us a 16% chance of finishing in the money to the upside. That is the 16 delta call. The closest one to that is 1080. Now, to finish it off, we want to find the option that gives us a 16% chance of finishing outside the expected move to the downside. So for that, we want to find the option that gives us a 16% chance of finishing in the money to the downside. That would be the 16 delta put. That is the 840 strike. The expected move from now until the end of the year in Google is 1080 to 840. That is it. Now, this is some really, really cool stuff. And what I really, really like about this the most is that it gives you reasonable expectations. If you're owning stock and you think, and you have a guess as to how far a stock can go, now you know exactly how to find out that information. If you're really worried about some downside risk, now you know some real expectations around that. So again, watch this video like a bunch of times. This is it. I'm telling you, this turns average people, not even average traders, this turns average people walking on the street to professional money managers, something like this. So this is really, really cool. I will see you on the next video.